So what is Reg A Plus? I expect quite a few of you know, but anyone anywhere within reason in the world can invest. The SEC considers those investments to be liquid post-purchase of the securities. The SEC considers this to be a public offering once completed. Not an initial public offering, but public offering with a P and an O, because you are selling shares to the public and you have some reporting obligations that go along with that. To enter into it, you need 2 years of GAAP audit if your company has existed that long. And you can raise up to $50 million in one offering over a 12-month period. And again, anyone can invest. They don't have to be wealthy. Anyone's allowed to invest. Interestingly, the nature of investors in Reg A Plus tends to be quite different than one would expect, certainly different than in a Reg D offering. I would say generally they are optimists, and you can tell that by a couple of these indicators. 60% of the investments now come in via smartphone, which itself is interesting. And out of 100 people who will end up investing in a Reg A Plus, about 1 or 2 of them will invest on their first visit to the offering page. You know, this is clearly optimism. And I see the comments coming in to our issuer CEOs, and sometimes they come to me, they're indicative of optimism as well. Interesting. They can invest in 4 to 6 minutes and move on. So that's a nice thing about it, using their smartphone or their tablet or the computer. The reasons they invest, that's where it gets interesting. And I'll get into that more in a moment about biotech, because it's more directly relevant to this audience. Frequent misperceptions about Reg A Plus that I want you to be clear on before we go further. One is that you have to do an IPO. Absolutely not the case. You do not have to list your company anywhere, okay? You don't have to do an IPO, you don't have to list it anywhere. If you do choose to list the company on an OTC market, then you are only obligated to have an annual US GAAP audit, which is relatively required to, in the case of the OTC QB, produce the same thing that Reg A Plus requires, which is, can you guys hear me all right? I'm getting an indication that my network connection is marginal. Okay, good. So the 6 monthly management financials, annual GAAP audit, if you are not listed or if you're listed on the OTC markets. If you go to the OTC QX, they will want quarterly management financials, but it's still 1 US GAAP audit per annum, which is, let's face it, a very lightweight obligation compared to having a PCAOB audit. Tier 1 is a mistake, really. I'll get into mistakes later on, but Tier 1 is a waste of time in almost all cases of Reg A Plus. You are allowed to, the flexibility in a Reg A Plus is something that people aren't aware of. You know, I don't recommend people do it for less than $4 million because of the expense and the workload involved. But you could go into a Reg A Plus with a given need and expectation and increase the size of the raise that you make during the raise, as long as you establish a large enough maximum. So I'll talk more about that later on. But the sort of misperceptions that people have, though, is it okay if we're pre-revenue? Yes, it is. Do I have to have a company history of 8 years? No, you don't. To do a Reg A Plus, right? How big, you know, do I have to have a cast of thousands, you know, 12 executives and 200 employees? No, you don't. Really what it comes down to is that early stage companies can have great success using Reg A Plus when what they're doing is very attractive. And of course, the caliber of the people involved is strong, and the technology or the product is strong and has barriers to entry, etc. So it isn't necessary to be a big company already. It is necessary to have some money to pay the cost of doing it, and I'll get into what it costs and things later. But biotech companies, let's face it, you know, if a biotech company's already got FDA approval, then if their product's successful, they've already, you know, they're already gigantic, or they're about to get bought out. The companies that we see in Reg A Plus are the ones that are a bit earlier on. You know, they're preclinical, they're in most cases, and it's okay to do that. You know, if it's appealing enough to the investors, it doesn't matter that it's going to take some time to get through the FDA process in order to go to market. Why Reg A Plus over venture capital? Of course, you know, there are some lovely things about venture capital. Some VCs are phenomenal people. I've had the good fortune to work with some of the best Silicon Valley VCs in some of my earlier startups. And my God, I didn't talk about me at all at the beginning. Well, you know, I will pause for a moment and give myself a little bit of credibility here, I hope. So you'll listen, although I hope you're already listening, and explain what Manhattan Street Capital does, because I skipped that. That was unintentional. So I've had the good fortune to be a founder or top executive, a senior executive at 6 prior tech startup companies that we built to scale. 2 we took public to the NASDAQ. Symantec with the Norton antivirus is the better known company, the more recent company of the 2. I've also formed a venture capital firm in the past called Irvine Ventures, based in Irvine. What a surprise. That was interesting as well. I was in the in the first internet bubble. Very expensive experience at the end of the day, but learned a lot. So I have a lot of relevant experience. I'm an engineer that's managed to morph into and learn the other skills necessary to be a successful leader and executive. I ran the largest mergers at Symantec, which were very challenging and very, very worthwhile. And what Manhattan Street Capital does, I launched the company 5.5 years ago because of Reg A Plus, to raise money in Reg A Plus, because in my opinion, when it hits stride, which is taking longer than I thought, it's a $40 to $50 billion a year capital raising market. And there's so much good that we can do in helping companies raise money that otherwise couldn't, or that otherwise couldn't in such an attractive manner. It's really worthwhile doing this. I could retire. I had a retirement phase earlier on. I've had a lot of good fortune with my career, but sticking to the straight and narrow here, Manhattan Street Capital has been in existence for 5.5 years, focused on Reg A Plus. We do Reg D offerings as well. We are an offering platform and consultancy that helps companies decide if they should do it in the first place, right? You know, that's the first thing. Companies engage with us to find out if it could work, if it could have, because the last thing we want to do is be a part of taking companies through an offering process that will fail or struggle. So we're upfront qualifying companies and helping them figure out if this is even a good instrument, or if Reg D is, or if they should do something else, and sending them off in another direction where appropriate. And we are a funding platform with great depth and selectivity. We're selective. The platform is very deep. There's a lot of things it does that basically build on the fact that I'm an engineer, right? You know, we have an algorithm built in that tracks everybody's activity at all times in order to identify risky investors. You know, that was an idea I had before I started the company, because I liked the idea of the free form context I had was accurate reviews. You know, use that in a different context to figure out the behavior of people and have it indicate whether or not what they say is valid. In this application, reduce litigation risk by identifying risky behaviors in potential investors in our companies, in our client companies. I won't belabor the points of how wonderful the platform is, but it is a wonderful platform. But I'm not here to sell you guys on that. I'm here to inform about Reg A Plus, and if you want to look further, great, and we'll get into that later on. Okay, so Reg A Plus over VC, You don't have external board member seats to, you know, powerful people that have a lot of clout in your company. So you are more likely to stay on board as a CEO and be able to adhere to your strategy, right or wrong, right? I mean, there are times when their value added up there can be really useful. So it's not a complete no-brainer. And much less dilution, because in my experience in a Reg D with angel investors or VC, that's, you know, it's a fair deal. You raise enough money to grow the company a year and a half, you're going to give up 25 to 33% ownership in the company. And then when you do it next time, we'll have the same kind of dilution, unless you're, you know, experiencing very, very rapid growth. So lots of dilution there, and a lot less dilution in a Reg A plus. If you look at the numbers and observe what kind of valuations Reg A plus that are offerings that are legitimate and that are well received and accepted carry, there's less dilution, okay? I'm not a valuation professional, but let me just leave it at that, substantially less dilution. As well as liquidity. You know, we have venture funded companies approaching us because the VCs introduced them, because they want to get liquid. And, you know, there's reasons with VCs where they fund it as much out of fund 2 as they can. The company still needs money to grow, and they aren't allowed to use fund 3, 4, or 5 to put more money in. They need to get other investors in, or they need to raise money through another method. So we've had VCs come to us. I would say I have a tremendously good contact network in high tech. You know, not too many of those companies have been those that would do well in a Reg A plus so far, frankly. But some of them can and will, obviously. You know, over time, that will become a viable and attractive portion of our business. It's a matter of which companies when, right? So liquidity is a big advantage in Reg A plus, and I'll get into that further later on, because there's some pleasant surprises beyond the obvious there. Why is Reg A plus good for biotech? In my experience at Manhattan Street Capital, our two biggest segments of exciting company offerings and offerings that we're bringing to market are biotech and medtech and real estate. Real estate's obvious and easy to understand. You know, the big raises in Reg A plus do tend to be in more of them than anywhere else in real estate. But biotech is where I see tremendous opportunities, and we've been sort of pushing to do more biotech companies. We have some exciting companies going live with us soon. I've got to be careful that I'm not allowed, because I'm not a broker dealer, I am not allowed to pitch any of our client companies, right? So I can describe them in a linear fashion, but I must not pitch them. I must not try to sell them to you or anyone else. So I'll tell you about a couple of the companies that we have that will be going live that are biotech. One makes human insulin it's an overnight success, 8 years in the making, proprietary insulin process. They will be selling it for 70% less than the market price of insulin in the US. I love that personally, and I think a lot of investors will want to back that company. We have another company we have two companies that have different COVID-19 tests, that one is closer than the other to going live. Each of them knows about the other. Obviously, I introduced them to make sure that the newer of the two and the one that's already in our system were happy with each other, to make sure that that wasn't going to be a problem. One of the nice things about Manhattan Street Capital is that if you do a Reg A plus with us, your offering is isolated. Within our platform, it's isolated from everyone else's offerings. There are no buttons saying, click here to explore other investments. You know, we don't do that kind of thing. We don't allow that kind of thing, right? So the money you spend bringing in investors doesn't get filched off into other offerings. So those are two examples. There's some really neat companies, other ones that I won't describe, because that's not the purpose of this presentation. So why biotech can be great in Reg A plus? Well, people care and there's high awareness, right? That's the primary thing. Okay, if it's a B2B business and it's boring and hard to explain, it's not a natural for Reg A plus, right? Then if it's going to work, it's because the company has substance and it's paying a decent dividend, and the dividend is what attracts investors, and the substance is what makes them feel like, okay, this is an okay company to invest with, because they're going to stay open and they're going to be able to continue to deliver the dividend payments that I would love to experience, right? But if it's going to be an equity sale, then it's got to be simple to explain, and it has to be really engaging. So we did a Reg A plus for a company, in situ biologics, a non-opioid pain killing. They're preclinical. The first version of their product of their technology, if you will, they can deliver a lot of things with their technology. The first example is delivering a pain medicine for surgeons. So surgeons, just before they stitch up their patient, they insert this gel. The gel biodegrades and is biocompatible to human beings, and it slowly delivers the painkiller where it's needed. So you don't have to pop pills, so it avoids the opioid risk. So this is a clearly exciting company. We had great success in their Reg D and then great success in their Reg A plus, in part because we were working very well together and the marketing agency did a marvelous job, and in part because it's an engaging offering, easy to explain. And the opioid epidemic is a huge issue in the US especially, so it resonated with the audience. That case, the average investment amount was about $8,000 because so many physicians and anesthetists invested, which is unusual, right? That was very appealing to them, and obviously can apply to other biotechs. But it appealed very broadly to consumers as well, for the obvious reasons. So consumer empathy, yeah, I want that. I want a cure for Alzheimer's. I want to have a cure for triple negative breast cancer. I want to fix diabetes. People care, right? And of course, they see the financial upside too in solving some of these huge problems that need to be addressed. So when it's understandable and easy to convey in an online advertisement on social media, then is when it clicks. And when people care, so much the better. If it's, there are things that there are companies in biotech that I've advised not to use this method, where there is no way to depict what they do in a way that doesn't revolt you and turn you off, make you want to throw out your laptop or throw away your phone because it's so disgusting, even though it's doing something really worthwhile. There have been those examples. But when we're doing things that people care about that are not of that ilk, then biotech's wonderful. And I just feel that biotech companies of the right stripe are the examples where Reg A plus really kicks into gear and can be a super tool to use. Clearly, big path to financial upside. It brings in a swath of investors who want that. Okay, so now I'm going to touch on the Reg A plus timeline and costs, and then I'll get into some of that in more depth later in different ways. But essentially, it's 2 months to prepare the offering, 2 months to get it through the SEC, as long as it's being prepared properly by a security attorney that knows their stuff. We bring all the service providers to the table that are experts in their field, and that saves a lot of time. And also, especially with the SEC, when those attorneys are respected by the SEC Reg A people, helps, right? It helps. You don't want to be learning on the job really with that or anything else. So auditors, attorneys, marketing agencies, where relevant, broker dealers, you name it, we bring the service providers in direct. You are their client. All we do is introduce them, make sure it's going to work. Otherwise, we wouldn't introduce them in the first place. Make sure they get it and they understand what they're doing, and that you're getting a good deal. And there are no backdoor deals with us. We are I suppose, an honest broker is the right term for that. So 4 months to qualify is reasonable if you're on it, not, falling asleep at the wheel or getting distracted. And once we go live in month 5, then you have a year to raise the money. You can pause the offering, you can change the security price if it's an equity offering as you go. Up to 20% cumulative share price increase is allowed in a very, very simple notification method. You wouldn't do 20% in one step necessarily, but that's the amount that you can do where you notify the SEC and you have 48 hours to go live with it. If you want to do more than that, then you pause the offering, apply to the SEC, and if you do nothing else, you'll get a quick turnaround. And during that time, you do pause the offering in order to do a more substantial share price change, like a share split or something like that. The reason I mention this is that a huge percentage of the companies that approach us to do Reg A Plus, there's a number they need, there's a number they want, and then there's the unpredictable, right? So a company that needs $12 million, then of course they should be pricing the offering according to how much they need. That's the right thing. But my recommendation is to set the maximum to 50 so that if the offering goes really well and the money raising is really easy, then say at the 12 million point, they make a substantial revaluation, up the valuation significantly in order to raise more money in a managed state of dilution. And if there's good news, an acquisition comes along or some other thing where it's prudent use of funds and you want to raise even more money, same thing applies, right? Having that flexibility is one of the great strengths of Reg A Plus, frankly, that ability to dynamically adjust the key terms. You can't adjust the maximum once you've got it qualified, though. You can't go back and say, you go with a high number in the first place to give yourself that flexibility. Okay, so then costs, just the sort of the bird's eye view of it is that for a simple entity, this is, audits vary greatly, right? If you've got a way complicated business company with revenue, with all sorts of subsidiaries and things, then I have no clue sitting here right now what your audit cost is going to be, even though it's only US GAAP, of course, right? It could be expensive and slow. But in a simple case, then it's, it's a modest amount of money. So 150K is sort of the minimum you should be considering to be the cash cost to reach the point that we're live to investors in month 5. I wouldn't want you to depend on that. I would like you to have more money on hand, but that's the minimum you can really do. Okay, could get a little lower, but let's not waste time prating about perfecting it. 150K is about the minimum you're really going to get away with in most cases, unless you already have an audit, unless let's forget the exceptions. So now you're live, and in the first month, I'm talking typical situation. What biotech company that hasn't released their product yet has a ginormous fan base or huge customer base? If you do, then the marketing can be almost free. But there aren't very many biotech companies that are in that situation. So I'm not going to talk to that very much here. In the realistic situation where we don't have a big fan base to deal with, we're going out and creating momentum from the Manhattan Street Capital member base and from the great unwashed masses who don't know yet about how marvelous your company is. That is where the social media advertising comes in. And we'll typically recommend that, and the agency will recommend the same, that you spend about $10,000 in advertising during the first month, because we don't know what we're doing, right? We're testing. Akash, somebody's waiting. Okay, you got it, thank you. We don't know what we're doing yet, right? We know we don't know. We're tuning and testing and adjusting as necessary. The target audience, the nuances of the targeting of those different audiences, the advertising and the nuances of the advertising, all of it's being tested. The key messaging on the landing page on Manhattan Street Capital is being tested. We might have 3 or 4 different landing pages in the early days if we don't know, if we really are looking at the messaging and we think we don't know where we're at yet, right? All of them going into the same back end, all of them handling investments the same way, but having a different lead message, which we're testing with a lead ad campaign with a particular audience. Don't normally need to do that, but that's a feature that we can do, right? So The point being that the efficiency is not there in the first month. Typically, in our Reg A pluses, we see companies raising 30 to 50K on that 10K spend, even in the first month when we don't know what we're doing, which is horrendously inefficient for a big spend, but for a test spend up front, it isn't too shabby. Then we recommend that you increase the spend as the efficiency increases. It's all about getting that marketing efficiency higher and higher and higher, right? So as the offering continues, there are some built-in characteristics that make it more efficient. We build a bigger and bigger and bigger audience of people that have invested and those that have not. And it's commonplace for people to invest a small amount early and then monitor it and then come back and invest a chunk more and then come back from their managed IRA account and put in 30K. You know, that kind of thing is not unusual. So as the credibility of the offering continues to grow, as the interactions and proof that it's real continue to grow, there's a lot of things we do to encourage our companies and help them do those things. Then the average investment amount increases and the efficiency of all the marketing increases. That's the norm. Okay, so what does that mean? You mean in a Reg A plus that is, say, 10 million and above, you should expect that the total cost, we're only talking about ones that should be done, right? We're not doing this if it shouldn't be done. That's clear cut. We have that discussion up front. If we're doing a deal that should be done, in the sense that Reg A plus is a good instrument for it, then 12%, maybe 14% cost of capital, maybe 10% if we're lucky. The best that we've experienced ourselves is 6.5% total cost. But please don't tell your friends about that, because you know it ain't gonna happen again, right? That was a perfect world situation. So realistically, 10, 12, 14% worst case is what I would expect as being the total cost of sizable Reg A plus, around 10 million, and obviously the higher the amount, then the efficiency can get higher and higher. Let me see here. That's cash costs. Yeah, if there's some warrant cost for us, and if there's any broker-dealer involvement, then it gets more expensive and there's more warrants involved. Okay, so that's a bird's eye view of expenses and timing. Broker-dealers, the thing to know about broker-dealer involvement in a Reg A plus is that there are really only three ways that you involve broker-dealers. In an IPO today, we involve them as underwriters at the right time, which could be at the beginning or it could be after we've demonstrated that this is a kick-ass success, and that is when they'll go to bat for us, so we engage them then. That's for an IPO, and that's a whole different puppy, and we are happy to do those. We've done those in the past with Reg A plus. In a non-IPO, then there are two other ways in which we use a broker-dealer. If we reach a point where it's already a very successful offering, but we're finding it more expensive to market instead of less because we've tapped out the easy-to-reach audiences, we haven't had that experience yet, but time to add a broker-dealer or two, right? And by that time, because we're already successful with the raise, they will love to jump on board and make it happen, right? And get involved, really, not just flirt with the idea, because at the beginning, involving broker-dealers to raise money is a waste of time, because their reps will not take the risk of reaching out to their clients when it may or may not succeed, right? It just stands to reason, and it's a fact. They don't want to burn their client relationships by making recommendations that might come back to haunt them. That's why if you're going to do it this way, you do it later where they're raising money, when they're chomping at the bit, beating down the door, and we'll get a better deal altogether. The cash up front will be lower, the commissions will be lower, and they'll actually do the job. That's the right way to go. The other need for them is that because there are 7 states that are not are saying essentially you can file with those states as your own broker, but not really in Florida. I mean, Florida and Texas are the two that matter the most. You can get in, you can do it successfully with Texas, and in theory you can with Florida, but in point of fact, in Florida, their securities department is overloaded and they have a hiring freeze and they don't like Reg A plus. So, you know, you're not likely to get Florida by the direct approach. So if you really want Florida, and it's a sizable portion of the investing public, then you need a broker-dealer on the offering to open up those problem states, particularly Florida. You don't need them day one, because day one we're testing and, you know, we just take reservations for Florida, right? In terms of managing and optimizing cash, there are two issues about using a broker-dealer in a Reg A plus from the get-go. One is that the SEC may have qualified the offering, but if FINRA hasn't blessed the broker-dealer terms, they won't qualify the offering. They wait on FINRA. So to avoid a delay, you can go live, you write up the offering circular, the offering is written without a broker-dealer involved. You go live, it's qualified, and then immediately afterwards, or a week later, or a month later, or 6 months later, you add the broker-dealer, and any FINRA delays don't impact the offering. They have no relevance because you're already qualified. So, and cash flow-wise, you know, even we have a 1% broker-dealer that took me 4.5 years to find and cause that to occur for us, where they're charging 1% on all the capital raised, but they're a really good firm, and they have an upfront fee that's 25K. Maybe you can negotiate, we can negotiate it lower, and then you have an 8K FINRA fee. If you're really worried about cash, you don't do that until we're already raising money. Fair enough. Depends on how much, you know, how much cash matters, and they aren't really going to cause much of a delay with FINRA if their filing is done early enough, because their 1% fee is so easy to bless, and they do a lot of deals with us for Reg A plus. Okay, don't forget you can post questions if you have them, which I will attempt to answer towards the end of this event. And how are we doing on time? We're doing good. So marketing methodology, I've touched on some of it already. Really, I've hit the main points there. There are some lists that we have access to of investors that sometimes work. Generally, renting and buying lists isn't a successful venture. Our list is a different story, of course. When an offering is live with us, then we promote it to our social media following, which is quite large, and to our member base, except those investors who are currently involved in another offering that hasn't completed, right? As you gathered earlier, they're off limits. But we do that, and that helps, but that is never the solution unless we were to get insanely lucky because of some of my contacts or something. Realistically, you're not going to raise megabucks from our user base. Maybe that's going to be 10%, 15% of the raise, but not immediately, right? Realistically, the offering succeeds or fails based on the outreach marketing, which is where we and I get heavily involved with the marketing agency. The marketing agency selection is absolutely critical. We have 3 agencies that we know and love and work with that are excellent at this. There are too many agencies out there that aren't very good, waste time, waste money, and especially some bigger agencies with a good name and have a good reputation because of prior successes in Reg A plus, but they charge too much. You know, maybe they'll tell you that you have to spend 10% of the raise on the advertising, and then their fees are 10%. So now you're at 20%, and then you haven't covered any of the other expenses yet. And that's what they say coming in, you know, and then it'll be worse than that because, of course, you know, that was their initial goal. So we don't touch those agencies with a 10-foot barge pole for obvious reasons. How to get investors, I already said that. Okay, so now, minimum raise, unless you're buying something, set it to 0. The SEC is happy to qualify Reg A pluses if they're prepared properly, where the capital raise minimum is 0. Let's say at the end of the first week, there's $10,000. That would be more than usual with a 10K month spend. But let's say 10K is in or 5K is in, and you'd like to test out the escrow. It's not escrow really, you know, the segregated account transfer process. You do it and you move the money over right away. You can do it daily if you want, weekly, monthly, it doesn't matter. You certainly don't wait to bring in funds unless you have an escrow minimum because you're buying something, or you decide that it's only worth doing this raise if we raise more than 20 million. That's a nightmare scenario because then you have to spend every dollar of expense to raise 20 million before you can close escrow. You know, please don't do that unless it's truly the case that that's the only way that the raise makes sense. And then how the heck do you fund it? I don't know, but that's not something that we want to have to entertain unless we can avoid it legitimately. Maximum raise, set it high, 50 million is the current max. SEC's thinking about raising it to 75 million. We'll know when we know. Pricing we covered. Post Reg A plus liquidity. There's some interesting things here. One is that the SEC, from the SEC's perspective, as I said earlier, the Reg A plus investors are liquid. Pretty much everyone knows that. But everyone else is liquid too, guys. So the founders and old, long-term investors, everyone else is liquid unless you lock them up, which you may end up wanting to do. But that doesn't mean there's liquidity and it's easy for them to sell, but they're allowed to sell to anyone in the general public. It doesn't have to be a sophisticated investor, obviously, because Reg A Plus itself doesn't require that, right? So if these investors have exceeded, or shareholders, founders, have exceeded their Rule 144 holding period, then liquidity is really cool with the following constraints. The insiders and the investors that own more than 10% of the outstanding stock are limited by, they can only sell for 2 weeks after each time the company makes its management financial report or its audit report. So in a standard Reg A Plus, that's annual audit, 6 monthly management financials, okay? So they only have a short window, and in that window, they're only allowed to sell less than 1% of float per day. And guess what? If you're not listed anywhere, there isn't much float, right? So then we get into what I'll cover in a few minutes, the post-listing opportunities that exist. So, but, be aware there's a hell of a lot of wonderful liquidity options here that, you may or may not want. You can control them, but they do exist in terms of a side effect of doing a Reg A plus. So I'm going to talk to the one that I find the most interesting, really. Of course, you can fashion direct liquidity to the investor in a Reg A plus, but that's not what I'm going to talk about. You can do that within reasonable constraints, and that makes it easier to raise the money because investors see that if they're pressed for cash, they'll probably be able to get some or all of their money back. But and I can dwell on that. I can get back on that later if you guys would like me to. But what's happened? It's been ages coming. Let's face it, Christ. The whole Reg A plus awareness thing is still this sort of best kept secret after 5 years and a quarter on out and about and being used. There are now these exchanges that are called ATSs, alternative trading systems, which are like broker dealers. And they are allowed to to establish markets for Reg A plus securities. And there are quite a few of them doing that, and they're happening now. I'm getting regular calls from, and actually emails from these guys asking me to brief me because they want, our companies to go list on their exchanges. I love this. I love this because these exchanges, they don't really solve the insider problem, right? I mean, the momentum isn't the volume isn't high enough to solve that issue, but the volume is, not the volume, excuse me. The point is that, let's say, the point is that you can list your shares very easily, inexpensively, and people can buy them and sell them, and there's no naked shorting, right? The big issue with being listed on the OTC markets or on the NASDAQ when you're a pre-revenue company and you only have sporadic news because you're waiting on the FDA clinical trials, this is a hell place to be. Unless it really is a hellish place to be, because guess what? You may know this, but I'm going to mention this because I didn't know this until the first batch of Reg A plus IPOs went out, and I was studying why they were getting hammered in the aftermarket. the truth is that stockbrokers are allowed to short newly listed, they can short any stock that's publicly traded without borrow. They don't have to get borrowed. So any stock that's out there, and especially newly listed stock, is super vulnerable to being hammered. That is a big reason there's so many broken public companies. Of course, there are other reasons. I don't mean to defend the flaky companies that are out there, but my recommendation to you is rarely, please don't do a listing on one of the major exchanges or on the OTC markets unless you are thoroughly prepared with news announcements stacked up and a internal strategy to somehow condition the markets. But when the hell do you have that in a biotech company that's pre-revenue? Really difficult situation. So I look at these aftermarkets, and by the time any of you would be doing a Reg A Plus with us and ready to use them, I'll have solid recommendations. I have a preliminary favorite now, but it's too early because I haven't learned about the ones that have been reaching out to me that I haven't made time to talk with because we're getting so many neat companies approaching us. Anyway, so the point is that no naked shorting. It's simply people who are investors buying and selling. And during the Reg A Plus, you can list as long as you've got, typically more than 2,000 investors already, which means, you raise some money in your Reg A Plus. One of the ones that I like is a preliminary basis. They will require companies that use their system to do management financials monthly, right? That plus a modest listing fee plus 2,000 plus more than 2,000 investors, which most Reg A Pluses get. And you can list even during the raise. And if you want to do it during the raise, then the marketing of the raise will support the price to the aftermarket. And afterwards, you want to market the company anyway. If you want to support the aftermarket, you could do every year a small Reg A Plus to promote and raise the share price if you chose to help provide better liquidity, or have selling insiders up to 30% of a Reg A Plus can be selling insiders anyway, right? I think you guys are aware of that. Okay, so again, if you have questions on this stuff, come back and put them in the chat box if you can find it. It's under more. If you click on the button towards the bottom right, it says more. One of the options is chat, which really means type a message, type a question, and young Rod, who isn't young at all, can see those messages. Okay. Keep marketing anyway, right? Doesn't matter that you don't have a product down. Yep. Covered all the important things there. Next item. I'm going to mention Reg A Plus advantages to do an IPO versus an S-1 IPO here. So essentially, there are really a couple of big advantages. One is that the marketing of the offering itself creates a lot of brand ambassadors, which is helpful, right? You can't do that in an S1. That's it varies according to the nature of the company, how valuable that one is. Another one is that in an S1 IPO, let's say you have to raise $12 million to list on the NASDAQ, and you reach a point where the underwriters come back and say, we're at 9 million, we can't make 12, and they're not willing to change anything. There's nothing to do to improve it. Then guess what? Your offering failed, and all the expense, which was significant, has been incurred, but you can't bring in $1. You had 9 million lined up, but you can't close on any of it. That would be the ultimate frustration, of course. In a Reg A Plus IPO, you are allowed to close the investors that you've got. In fact, my general recommendation is, it depends on the climate and it depends on the company, right? If your company is so compelling that we provide a service of lining up underwriters for a Reg A Plus IPO, if you want to do that, if you want, and we can help you find them to qualify and see if your company is worth, it will get the right attention to do an IPO via Reg A Plus or S1 for that matter. So that's a service that we do offer. But my point is that at the beginning, a lot of the companies, essentially the underwriters have it too easy at the moment. And they're saying things like, yeah, raise 8 million and get some strategics, and then come back and we'll do your offering with great pleasure, right? That's the sort of thing that you will hear in many cases. So yeah, right, we can raise the 8 million in a Reg A plus, why not? Close the money, and that's a significant advantage. If it turns out for some reason the IPO couldn't complete, then it doesn't matter, because we closed a lot of money along the way, and you know, it wasn't a waste of time. The other big advantage is that the service providers, especially the auditors and the securities attorneys, charge a hell of a lot less when you're doing a Reg A plus than they do when you're doing an S-1 IPO. Drastically lower prices. And you don't need PCAOB audits in your Reg A plus that you intend to list on the NASDAQ. Post listing on the NASDAQ, then the first quarter after listing, you have to have a PCAOB audit. But you don't have to have one just in case ahead of time. Your US GAAP audit is enough. So you save a lot of money in audit and securities attorneys' fees, and you have that flexibility to close the money, for Christ's sake, which, you know, let's make sure we bring in money versus almost bringing it in. Those are the advantages. The disadvantage is it's capped at 50 mil. And if your company can carry more than that in an S-1 IPO, you know, if you can raise 300 million, you should do it with an S-1 IPO, with the underwriter support that goes along with that, right? That's, you know, we aren't doing Reg A plus IPOs that raise 300 mil, because we're not allowed to. Okay, so covered that. Mistakes to avoid. Some of these I've touched on, but, you know, I want you to be aware of them. Misfit companies, the single biggest reason why companies have failed in Reg A plus is because Reg A plus was never going to succeed in the first place. It was never the right instrument, right? So use us as a sounding board, whether you're going to work with us or not, within reason. You know, we don't want to entertain casual conversations that have no chance of anything good coming from them. But, you know, I'm happy to give advice. Point being, there's been so many companies that did Reg A plus filings and then fell on their noses because it was never going to work. It was always a company that was preordained to fail in a Reg A plus context. It could be a fantastic company, but that doesn't mean Reg A plus is the right instrument. It's not just about having a fantastic company. It's about having a fantastic company which has the right characteristics for Reg A plus to click and be a good instrument to use, right? That's been the biggest source of failed Reg A pluses. The second one has been do-it-yourself companies that think they can put it all together themselves and learn that they can't. So I recommend you don't do that. That you work with someone like us or one of the other companies that help with Reg A pluses. I think we're the best, of course, but I'm a tad biased in that belief. Okay, high minimum escrow. So companies will sometimes convince themselves that they really shouldn't do it if they don't raise more than $8 million, and then you've got this horrible cash flow burn to reach $8 million. If it's legit, because you're buying a building, well, that wouldn't be too relevant to biotech, would it? But if you're buying a company, then their price is 8 mil, and your company has nothing until you hit 8 mil. That's a legitimate reason to have an escrow account and raise 8 mil, as long as you can afford to raise it, right? A lot of expense. That is a seriously expensive mistake to make if it was not needed. Establishing a high minimum amount per investor for any reason is a bad idea. You know, I've had companies approach us to work with us where they're already qualified and they set a minimum of $5,000 or $10,000 per investor because they're thinking like the old days when you're raising money from Reg D investors. And I had to refuse unless they would change that number down, which you can do actually, because there's no way in hell we can add any value. You know, a Reg A plus with a minimum of $5,000 or $10,000 is preordained to fail. The average investment amount will be $10,003 and nobody will invest. That's just a fact of life. You need to when you recognize the mechanism by which we raise money, it is reaching out to people to bring them into an offering page with some compelling message, right? Cure Alzheimer's, that's a little bit, we wouldn't probably be able to say cure Alzheimer's unless it was a lot of proof, which we wouldn't have the proof, but you get the gist. Something motivating brings them in. They go to the offering page. What do they want to see on the offering page? They want to see, am I really allowed to invest in this? Can I afford to invest in this thing I haven't even evaluated yet? And do I like it, right? If the minimum is 5K, at this instant, I'm a real casual visitor. And I'm thinking, 5K? No way. And I leave and never come back, right? That's what happens. If you have a low minimum, you know, not ridiculously low, but say $300, $400, then these people parachute in. These are regular people, remember, but they're not accredited investors in the main. They're regular people who have some disposable income, who believe in what we're doing, who really want to back us. And I'm saying us as a part of your team. And I can't even see you, you know, but you know what I mean. I can see 3 of you. That's a good start. Anyway, so the point is that the dynamic of bringing in people through social media advertising, which is what we do, that brings in investors that are going to find the offering interesting, it's got to be at the moment they arrive, but it's really casual. If we can get them to stay for 10 seconds by not rejecting them by some obviously stupid move like having a high minimum, then we want to keep them for 30 seconds because the content is compelling. If we got them for 30 seconds, we want them to stick around for a minute and a half or so. And then, you know, then we're in with a really good chance to raise money from them, right? It's a progressive sequence of events. Some of them don't need the minute and a half of attention, but anyone that comes in from an ad, they were doing something else, remember? You know, think about it that way. They are generally on a quest to find our company. They're doing something else. They get interrupted by an ad that's interesting. It's still an interruption. We've got to make sure that it's really compelling for the first 10 seconds. Don't blow them off with a minimum investment amount that will, you know, kill it dead. I spent too long on that. How are we doing on time? I think we scheduled 3 hours for this, so we're good, right? I'm joking, of course. Okay, so relying on a broker to raise the money at the front end is a complete waste of time in almost every case, unless it's your brother and he cares about you so much and he's going to make it happen because he's your brother. He's got to deliver, otherwise you'll fire his ass or something. Part of my language. I'm British, you know. If I had my free will, I'd be swearing profusely as we go along here. I'm trying to moderate that characteristic. Okay, so do it yourself. I said it's a bad idea. It is. We get companies that approach us, and now I've started to recognize their characteristics that end up being do-it-yourselfers. And the only rewarding thing for me when they implicitly reject us, which pisses me off, is that they fail. They don't usually succeed. So at least I feel slight. If they had gone off on their own and had a blistering success, it wouldn't feel. That's me being egotistic. But hey, I'm a human being. A flawed human being at that. Expensive law firm, big auditor. You know, we had a case where a practiced, knowledgeable law firm doing a securities offering, charging 50K, got replaced by a giant law firm, and they didn't know what to do, and came back to her and asked her help. And they charged an amazing amount of money. A real estate company that had just qualified approached us. They had spent $300,000 in legal fees getting qualified with the SEC. Just that. When we can get you as a great securities attorney to do that for 40, 50 or so K, right? For a real estate offering, it might be a bit higher, but 40 or 50, maybe 60K, right? That's the sweet spot for really qualified, smart attorneys to do this. I mean, I'm not believing, I mean, big law firms do charge more, that's okay, they're worth it in general, but you know, sometimes it's silly bugger numbers, you know, $300,000. And not only that, it took months, it delayed the whole thing, right? It wasn't just the cost, it was the delay. Big auditor, please don't do that. We had a company planning an IPO, superb. The NYSE rolled out the red carpet to us back in 2017, 18. This is a superb company, but the CEO was insistent in his use of Deloitte, and he had an entity in the US, he had one in Singapore, he had one in India. Deloitte never came through with an audit in time for us to get the SEC filing sorted, not once. The complexity of it, you know, in that situation with a giant auditor and a dinky little client, they don't put A-level teams on, they put B-level and C-level teams on, and you're wasting humongous amounts of money and you just don't get any results. So that was an extreme case. His board told him to terminate the Reg A Plus and S-1. Whatever ideas he had about that were all out the window because of this attachment to Deloitte. Lovely Deloitte company, you know, for the right customer, but not for this situation. Tier 1 Reg A Plus is a complete waste of time. It's virtually never a situation that it's useful. In 2019, slightly over $1 billion was raised via Reg A Plus. 4% of it came in Tier 1 deals. And I think it'll be 2% in 2020. Of that billion, 65% was real estate. The big raises tend to be real estate. But my intention and belief, because we're doing a number of really exciting biotech companies, it's taken too long to get a lot of biotech companies, partly because I didn't do webinars like this one focusing on biotech, but now we've got a good pipeline. To me, biotech is a sweet spot, and it's not dependent on a real estate cycle, because real estate isn't always going to be in a lovely cycle, right? I don't like that cyclicity. Okay, US only, no, we want to raise money outside. It's less expensive to find investors outside the US, much less expensive. So let's not be US only. Don't allow debit credit cards because we're afraid using debit and credit cards makes it so much easier for people to invest. They're done in 4 to 6 minutes, and you know, ACH is an alien concept to a lot of millennials, right? They don't have a checking account, for heaven's sake. The idea of ABA numbers and account numbers and things is a really, you know, is not cool. They're into Apple Pay, right? So it's a bad idea not to allow debit and credit cards. A lot of companies are too intimidated by how many investors they have. I won't waste time on it, but it isn't as bad as you think. You use a transfer agent to handle all the detailed stuff. You need to have a transfer agent on a Reg A Plus for a variety of reasons. Anyway, thinking it's remote control, the service providers can do it all. It's never going to be that way. There's got to be engagement from internally. There's a lot of things that I'm going to want the CEO or spokesperson to do to generate better and better engagement and less expense. Okay? It is not remote control stuff. We do the lion's share of the work with the service providers, but there's a lot of work you must do. Neglecting social media comments, I won't belabor it, but there's a serious need for that. It takes some degree of time, depending on how excited people are, how many comments there are. Committee decisions, making bad decisions, using the wrong security, I won't belabor that, but that's the sort of thing we help with. This, to the extent we're allowed to, we'll nudge you in the right direction without telling you what you should do, because we're not allowed to. Reverse mergers, you know, we have a company right now that's a biotech. Almost, they came to us when they were almost qualified, and they realized that things in their filing, and they are extracting themselves from a reverse merger that they did, thinking it would make it easy, which is not the case. Generally speaking, in a Reg A Plus context, you don't need to have done a reverse merger. Okay, that's it. If you guys want to hang on now, I'll attend to the questions, although I don't see any, but that's because I'm looking at the bottom of the stack. Okay. If one is ready to start trials, Reg A delays you, or am I missing something on the timing? Well, if you don't need the money, don't use Reg A Plus. If you need the money, use Reg A Plus. If you have other sources of capital, like VC, that are instant, and you need instant, if you need it instantly and you've got it available, take the money. Bird in the hand, two in the bush. I understand the need for professional advice you provide, but in general, is there a litigation risk with a lot of non-accredited investors? I would say, to my mind, the litigation risk is lower because of a lot of non-accredited investors. It's not worth their while, and they're not litigation happy type people. They're optimists. You get more risk from accredited investors, frankly. So far, I haven't seen any litigation from anyone in any Reg A pluses. There might be some that I'm not aware of, but I think I'd be aware by now. So we're in. Does 10 to 14% include 150K for audit and legal? Well, if it was 150K for audit and legal, then that would be silly expensive. I would say audit, I mean, it depends on the audit, right? I mean, you can have a 100K audit because it's absolutely necessary. But that, I would say, if you take audit out of my estimate of 150K and take out legal because you have somebody you want to spend a lot of money on, then, but actually, yeah, I realize I misunderstood your question. Yes, it includes all expenses. It does include, it includes all expenses, but it wouldn't be 150K for audit and legal. 150K is all, that number I estimated for you is all the expenses to get live, unless you make the mistake of bringing in super expensive providers in audit, legal, or anywhere else. And it assumes a simple audit. Okay, well, a long one here. MSC does not verify or assure that, oh, it's our disclaimer. Yeah, there you go. I don't think I'm going to read that as a question. Jesus Christ, it's such a long block of text. Okay. Hi, Roy, I can hear you just fine, thank you. Is that it? No more questions? Oh, one new message here. All right. The premiums for directors and office insurances have skyrocketed for public companies. Do Reg A pluses have the same D&O insurance requirements as for public companies? Well, I am not an expert on D&O costs. I was recently approached by a service provider that I haven't spoken with that provides D&O at a, they say, much more efficient cost. But I think there may be an opportunity. It's a heck of a lot lower risk to be a Reg A plus offering that completed than it is to be a listed company, I think, from a litigation standpoint. So it makes sense logically that D&O insurance would cost less, but that doesn't mean that's going to happen, right? You know what I mean? I've got a ping here. Bear with me a second. Something else. Okay, so actually, we don't have any more questions. User privately, I don't see that. Yeah. Or how do companies keep engaged with their investors post-funding? Oh, there's some other questions I didn't see. Okay, so I recommend quarterly phone calls, better yet, video calls. There's a super benefit to looking in the eye of the camera, which is looking in the eye of the investors. I think that's a super benefit, frankly. And doing it in a non-salesy manner, you know, open kimono style is good. Obviously, you don't want to create litigation exposure, but throughout the offering and after the offering, having regular exposure to the investors is just irreplaceably good, because you want them to be interested and aware. You want them to feel like they're a part of a journey. Many of the investors in a Reg A Plus are doing it for vicarious engagement reasons. They want to be a part of an offering. They want to be a part of it. They like your team. They selected your team. They want you to prove them right. When you do a Reg A Plus, are you only registering the offering of non-issued stock, or you're only registering the shares that the Reg A Plus is offering? How are insider shares included? They aren't included in the offering unless they are listed inside, unless you have selling shareholders. But the SEC considers all security holders that have surpassed their Rule 144 holding period as liquid. So what you would do if you want to make all of your shareholders liquid in the best possible way, you would pick the best post Reg A Plus marketplace and put let's say there's 5 securities that you have that are part of your company, and list all of them on that market. And that would make it easier for them to sell them as they are, right? That's the way to do it. And it isn't costing much at the moment. The cost, I'm sure they'll stay low because there's so many of them already. It's going to be a pretty crowded space. If one is ready to start, that's right, that's it. So there are no more questions here. Okay, good. So happy to receive email questions from you guys afterwards. I hope this was useful. The one downside of this stuff is I'm broadcasting and I can't tell if you like it, if it's worthwhile, if I'm missing the point. Please refer to the disclaimers and engage with me sending emails via any of the easy access ones, including the invitations to this event if you have questions. And I hope we'll be working together on some of your companies as we go forward. What else? Thank you, Akash, for all your work in making this happen. And as I said, there will be a recording of this with a clickable index that will be a blog post, and we'll send you a link to it within a few days or a week. So you'll have access to that. And that's about it from me for now. Yeah. Thank you very much for your attention. And again, I hope this was useful. Cheers, guys.